Happy New Year and welcome back to Lipper's Fund Flows Insight Report. Well, if you've been watching the markets this year, you know that China has rattled everywhere in the world that markets have monitored, from their own stock market to Europe and the U.S. In fact, for this flows week, we saw the Dow Jones Industrial Average crater 755 points on its way down to the 16,000 level. So overall, a very rough start to the year for equities. Let's take a look at our macro groups and see how investors responded. Well, this week we saw equity mutual fund investors remove about $1.1 billion from their funds. Taxable bond funds have not been untouched by this unsettled movement out of China. They removed, in fact, $1.7 billion from their accounts. Municipal debt funds, one of the few bright areas this week, taking in over $800 million. And money market funds saw about $10.4 billion this week. Well, as we mentioned, it's not been a good year for equity markets, as concerns about China's growth have rattled shareholders all over the world. We've seen the worst start to the Dow Jones Industrial Average in its history over the first 2 weeks of the year. So consequently, it's no surprise to see mutual fund investors pulling money out of their equity funds. But let's take a closer look and see where the activity was within equity funds. Again, it was a poor week, among the worst ever to start of January. Domestic mutual fund saw about $3.3 billion pulled from them, which is rather curious considering that the dollar has been strengthening in response to these to China's slowing economy. As perhaps the cleanest shirt in the hamper, the U.S. dollar is expected to move higher this week, which makes a surging non-domestic flows this week of $2.2 billion rather puzzling, since investors are buying into a headwind right now. We'll see if this dynamic changes over time. Elsewhere, investors were interested in managed futures as a good way to perhaps balance what's going on in their accounts, as we saw those funds take in about $363 million, and emerging markets, curiously enough, maybe a little contrarian move here, they took in about $246 million this week from mutual fund investors. Well, not to be outdone by mutual funds, we saw equity ETF investors also get out of their investments this week. About $7.9 billion drained from equity ETFs. A general risk-off attitude with a few exceptions. So overall, in terms of classifications, high yield, technology, financial services saw money being pulled from their ETF products, while on the other hand, resources, gold, treasuries all saw money flow into them. Now, the resources is a curious one because, again, oil prices have been cratering over the last many weeks, and so it's interesting that some investors have taken a contrarian attitude and have put money to work in the natural resources area. Overall, the week's worst outflows were suffered by SPY, about $4.9 billion drained from that fund. The energy ETF XLE from Spider also saw inflows of about $523 million, and the Spider Gold GLD also took in about $458 million this week. Well, the next group saw even worse conditions for them, as taxable bond funds were drained of about $1.7 billion this week. This is their 10th consecutive week of outflows. So investors, despite seeing a final pronouncement by the Fed that they did indeed raise the overnight rate by 25 basis points, still can't believe that this will not crater their accounts, and they've been pulling money out left and right. The biggest source for their ire, of course, and concern, and this is probably a little more sensible considering what's going on with China and the global economy, we saw high yield funds with about $565 million in outflows lead the outflow pack. Another group that can't seem to find any traction with investors, loan participation funds, suffered yet another week, their 25th in a row, of outflows, about $402 million this week. On the other hand, some of the more standard areas for investors like core plus bonds, they also had outflows, $216 million this week. So if there was a bright spot, where was it? Well, we saw U.S. mortgage funds, mostly this is double line total return investors, allocate about $422 million to that area. Core bond funds, which are less volatile than core plus, they don't have as much high yield in them, they saw inflows of about $298 million. So there were a few bright spots on the taxable side, but they were kind of hard to find. Next group to take a look at is fixed income ETFs. Here again, we saw in this case some inflows this time, breaking with mutual fund investors, about $1.1 billion going into them. But it was not as easy as that. Some of the week's worst outflows were suffered by JNK and HYG, the premier junk bond ETFs. There were, however, a lot of investors interested in Treasury products. This is where they made up ground. Treasury and government ETFs took in about $2.1 billion this week. This is their best week in terms of total inflows since October. So definitely a rush for safety by fixed income investors on that ETF product. Next group to take a look at is municipal debt mutual funds. Again, they've been on a tear the last several weeks, taking in $829 million this week. Despite some fairly flat performance in the market, they still look pretty enticing to investors who don't want anything to do with Chinese markets or concerns about oil and whatnot. In fact, lower oil prices are tending to benefit a lot of municipal debt sectors right now. They've had 15 weeks of inflows. Investors have been very interested in high-yield munis. Again, default rates in this area are still historically low. They took in about $353 million this week. Intermediate munis a little farther behind at $214 million. The general and insured group, which is kind of a very diversified national muni product, they saw about $127 million in inflows. We also saw, in terms of fundamentals, that the tax equivalent yield relative to treasuries fall from 89% to 86%. This means the yield is getting smaller on municipal debt, and that looks like it's in play right now with municipal debt investors. So the final area to look at is money market funds. They had $10.4 billion in inflows this week. Now, if we split this apart into our various groups, we saw retail investors pull out about $2.2 billion, while institutional investors added $12.6. Curious that they're trying to keep a little powder dry right now. If we break it down into sectors, on the other hand, we see tax-exempt money market funds with about $3.2 billion in outflows. Prime money market funds take in $11.6, and government and treasury also take in money, but only about $2 billion this week. Well, that'll wrap it up for this week's flows analysis. Join us next week as we'll go through whatever happens over the next several trading days ahead of the Martin Luther King holiday. And join us online anytime at www.lipperusfundflows.com to see where the data is headed. Thanks for watching.